Hey everybody, Hot Dog Boy here. Today I'm going to talk about a pricing model that can be helpful for any time span of trades, whether you're day trading, swing trading, or long-term investing. This price model is a basis for what analysts might use to predict price movements. So we have our base equation here. E times M equals price. E is your earnings, and M is your multiple, also known as your PE ratio. So let's start with earnings. Earnings are a function of the underlying business. Earnings are affected when the business does well, positively and negatively when the business doesn't do well. So some factors that could affect earnings are tariffs. Let's say you own an aluminum company, and the recent tariffs come out. You're in the United States, and those tariffs block the sale of cheap aluminum from other countries. Your earnings are then going to go up because the market is forced to go to you rather than China, where it might be cheaper, or another country where it might be cheaper. Tariffs aren't always a good thing, though. They can negatively affect your earnings as well. Let's say you own a company that manufactures tools. If you own a company that makes hammers and wrenches and you use a Chinese steel that you previously got for a lot cheaper, those tariffs that Trump put on steel now force you to buy American steel, which stimulate those steel companies in America, but will end up costing you earnings. Earnings can explain why Netflix recently came down from its 52-week highs in price. There was concern that more and more companies were moving into Netflix's market share. I bought the stock back in 2014. I decided to sell it in August because I noticed a dip in price, and I read people contributing that to more companies moving into their market share. Before it was alone, its product was purely unique, and I thought just the future. Way better than any other medium to watch TV. Coming from someone that hates watching commercials, I knew Netflix was going to be big. So I bought in 2014. I had great success with the stock, but I decided it was time to let it go because I think that their growth rate can't be sustained at the current level because other companies are coming in and eating up their market share. Despite Netflix being number one in the industry, and I think it will continue to be number one in the industry, there's only so much money out there to be won. And if Netflix goes from getting 70% of the market share to 55%, that's a dramatic decrease in the earnings that they are expecting for their company. Now we look at the multiple. The multiple is a lot more volatile than the earnings. And that's because the multiple is largely dictated by psychology and emotional factors of people trading. You need to remember that the stock is a share of the company, but the stock's price is not purely dictated by the underlying company. The earnings are, but the multiple is not. So when you're trading a stock, you've got to remember, if more people buy, the price goes up. If more people sell, price goes down, regardless of the underlying business. And that's based on the multiple. The multiple is particularly important in the short term. If you have a company and it's making consistent earnings and the multiple shifts up and down, it will eventually, provided the company doesn't make any mistakes and provided the economy is healthy, the earnings will keep the stock price from falling too low. For instance, I mentioned Netflix before. I had faith in Netflix for many years. In 2014, I bought it, and I just held on. No matter where the multiple went, it had a couple instances where it dropped 5% in a day or over that time span. I held on to it because I knew that it was a strong company underneath. So you'll notice stocks make a lot of moves around their quarterly earnings report. And that's because that information comes out, it updates people on the company's earnings, and it also tells people about new ambitions or acquisitions or other news that could affect how the market feels, which will affect the multiple. So whereas the earnings is very much based in the substance of the company. The multiple is all about the market's feeling around the stock. So, for instance, the outlook for next quarter. If the CEO comes on and in the quarterly earnings report he says, we did great this quarter, we hit our target of $3 earnings per share. Next quarter we expect to be around $2.50. That's a significant drop. That's actually what happened to Micron stock in their last quarterly earnings report. I had Micron. I was watching the stock price after hours as the CEO was speaking, and he said, yes, we beat our earnings per share by about 5 cents, which was really big, and the stock jumped up to plus 6%. Then he announced that there are struggles with the Trump tariffs. Micron wasn't going to be able to sell as many products to China. And so immediately after jumping 5%, the stock plummeted to minus 4%. So that was outlook for the next quarter changing the multiple. So despite earnings growth, outlook for the next quarter brought sentiment for the stock down, and so the price went down. New investments or expansion can also justify a higher multiple. If you were to take a look at a Netflix or a Tesla, they're spending money very, very quickly. So they have all these ideas that are going to go into either expanding new products or building new locations, things like that. Those justify a higher multiple because the market thinks that money is going to end up raising earnings. So any positive sentiment is going to make multiples go up, and negative sentiment is going to make multiples go down. It's much more volatile than earnings. Finally, we have exposure to the company. So let's say you buy a little stock that no one's really talking about, and then all of a sudden it has a big price jump, or the industry gets really hot, like a lot of these pod stocks. The multiples start to go much, much higher. People start buying more, people get excited, people write articles about it on Forbes or Seeking Alpha or Market Watch, and that multiple keeps going up and up and up. Multiples will naturally be higher in industries that are very investment heavy. They're going to be higher in younger companies, companies that are expanding, stuff like that. If you look at older companies like a Ford Motors or a General Electric, the PE ratios are going to be lower. If you look at newer companies like a Tesla, they don't even have a multiple often because they're not yet profitable. So it's important to recognize that the multiples shift a lot, and that can help track price movements. So if you hear about news coming out, or you see a stock or a company rather has a plan to expand that you think is going to be very successful, that's going to drive up the multiple. So you buy it when the multiple's low, and then you can sell it when the multiple's high. So if you do that in the short term, you can do what's called a swing trade. So you buy before the earnings, then the earnings report comes out, it's good news, and then you sell afterwards and you take that 2 or 3% jump. So earnings are particularly risky because you're not exactly sure what kind of information is going to come out. That shift in information can tank the stock 5%, or it can add 5%, or it can do basically anything. Sometimes it comes out totally flat. So it's important to remember too, at earnings you've got to change in your E value, your earnings. You've also got to change in your M value, because if good news comes out or bad news comes out, it can change that. So the effects of a stock's movement get compounded, because you could have great earnings and a great multiple increase, which sends the price flying up, or you could have terrible earnings and your multiple could go down, sending the price way, way down. So buying stocks before earnings, particularly in risky sectors like tech, or particularly in new companies, can be a very profitable or a very bad move that can wipe you out. So here's a model that I made of how I think the price of Tilray is going to shift based on the earnings and the multiple. So here you can see that the earnings are negative right now. That's because it's a new industry, so they're spending more money than they're making because they want to be able to expand and compete with those other marijuana industry players. So the red line here is the earnings. The dotted red line is the multiple that I think the industry will eventually settle at. So you can see right now, the black line is the price of Tilray. That's going to be the earnings times the multiple. So the multiple it'll eventually settle at is the dotted line, but that's not the current multiple on this chart. Because again, the multiple shifts according to sentiment. So I think this stock is way, way overpriced. The price is way, 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 way higher than the negative earnings and the rate that the negative earnings is going up. So on that October 17th date, I think maybe that day or a couple days after, the price will peak, because the hype is ready. Anyone that's read anything about weed being legalized in Canada is going to go ahead and buy that stock. And then they're slowly going to realize that there's not enough market share in the industry to support all these crazy prices. So those prices will decline little by little until you hit the earnings report. And when the earnings report comes out, there's a big information dump. A lot of that information is going to be negative because Tilray in particular, and a lot of these weed companies, I personally think all of these weed companies, are going to miss their earnings. So then the price drops rapidly because the multiple goes way down. The multiple is artificially high. There's been so much positive news about these weed stocks that everyone thinks that it's going to make them rich overnight. That all comes crashing down when that earnings report is missed. Then the price dips really, really low. You've got lots of negative press. You're going to read all these articles that are going to say things like, oh, the weed bubble pops. Can weed survive? Are all these companies going to go bankrupt? Then the company is going to be oversold. You're going to get lots of people that are going to say, oh, Tilray's going bankrupt, Cronos is going bankrupt, CGC's going bankrupt, when they may very well just need to survive through a period. Then they're going to rebound up, but they're only going to get to what that multiple price settles at. It's not going to be anywhere near as high as the price was before. It very well may be, but only once those earnings go up. So for the price to return to its highs of 300, I think it's going to take at least a year or so. It really depends on how fast they expand. But using models like this, we can look at earnings and price to earnings ratios and read things like Market Watch and Seeking Alpha, and we can pay attention to different catalysts that'll happen, like an earnings report or a presidential election, or let's say the midterm election in November, that could shift prices, and any sort of news dump that will reveal more of what the earnings next quarter could be that could affect that price. So I make models like this all the time to do any sort of trading. Swing trading, if I notice a catalyst, like a new industry opening up, or if I notice an election coming up, I will try to use a model like that to predict when I think prices are going to move, and then buy and sell according to that chart. So my Tilray short, I plan to cover after that earnings report, or maybe a little bit before the earnings report, depending on how the stock is doing at that time. If the stock declines rapidly because of negative news, I might not take the risk if the earnings report is good, and I might just cover my short right there. But if that number is not low enough, I certainly will wait for the earnings report because I think the news is going to be negative. But I'm going to stay on top of it because more information leaks out all the time. If you want to be a good trader or investor, you need to stay on top of that as much as possible. So in order to make the best use out of this information, you need to find a catalyst. That's an event where news is going to be released. There's going to be either some shift in the industry, some shift in the single company, or some shift in the country, so the macro economy or the world, that's going to cause either the earnings to be known, or going to cause positive sentiment or negative sentiment that's going to move that price. So a lot of people buy in when the multiple's low and sell when the multiple's high. Or if you notice a multiple is too high because you think something is overhyped or a company has a plan that you don't think is going to work, you can short, and then when that price comes down, you get out of that stock. And this can be applied to the short term or the long term. For instance, Netflix, I knew that they were number one in the industry. I really thought their product was just vastly superior to cable TV and on demand. So I bought at actually pretty high multiple at the time because it was a new company, so it was expensive. But the multiple was driven even higher, and that one particular factor I think was a very strong branding. I noticed on social media, girls would talk about how much they love Netflix all the time. You had the Netflix and chill meme. That's powerful branding. So notice things like that. Buy in the stock and watch the multiple fly up and the price right along with it. Try to make some money out there, guys. See you next time.